Good morning, everybody, and welcome to part three of our three-part web series. Our mission is educating you on the power of using experts to help you decode Medicare, long-term care, and taming the volatile stock market. When you're empowered with accurate and efficient information, you can protect your family, spend your healthcare dollars well, and remain calm and confident in your daily lives. The group of experts we had for this series included Keith Knabb of Affordable Medicare Solutions, myself, Michelle Perlow of Perlow Financial, and Angie Rehkop of Financial Care Providers. Each expert is highlighting one area of information in each 20-minute program. On Monday, we heard from Keith Knabb on making Medicare work for you. On Wednesday, I spoke about the challenging long-term care market. And today, Angie will teach us how to be confident and flourish in a down stock market. Angie Rehkop has been helping families for over 25 years tend to their financial futures. She helps her clients answer tough questions, design strategies, and make informed choices so they can pursue personal financial growth and well-being. We'll answer questions at the end of the presentation, and you're welcome to use the chat feature to send questions while Angie is presenting. Angie, please introduce yourself to our audience.
Hello, it's nice to meet you. My name is Angie Rehkop. I'm a certified financial planner, and I have been working in the Atlanta area for the last 27 years. It's hard to believe. This is not my first rodeo. This is my third market correction that I've been through. And market corrections ultimately for me have been a very good thing. I've had a lot of training, and and you have to help. I am helping to admit people into this meeting and managing my slides. So I'm new to this, so please bear with us. Let's see, my slides are not forwarding. There we go. One of the things that you recognize when you're getting trained is that no captain sets sail with their fingers crossed. That's just not a good way to go about it, and hoping that the weather stays good and not being prepared for what ultimately is going to happen as a storm. We've been through market corrections before. We know market corrections are going to happen, so we might as well go ahead and set ourselves up to be prepared and take advantage. Who is at the advantage when the market is down? It's always a buyer. Who's at the ultimate disadvantage? It's always a seller. So what I do is I set up my clients to do well when the market is high and take advantage of high stock values. I also set them up to do well when the market is low, so we can gather lots of shares of stocks when the prices are down. I do a comprehensive financial plan. I'm trying to make sure that we're ready for all the incidences. One of the things we're going to discuss is maintaining 18 to 24 months of emergency reserves. Rebalancing to your portfolio to the original asset allocation model. Some people are like, yeah, well, I didn't have that to start with. Well, what if you don't have an asset allocation? What can we do for that? Being patient and allowing the market to recover. The market doesn't make final moves in one day or completely get over it. It's a constant cycle. It's going to go on every day, and we have to be patient and allow the market to recover. Knowing when would be a good time to replenish your emergency reserves, because right now, if the market is down, we need to be living off your emergency reserves, and when the market is at a good time to replenish those reserves. And then reassessing your risk tolerance and getting a plan together that is post-pandemic and allows you to be ready to weather the next market downturn. For the 18 to 24 months of emergency reserves, you need to keep money in CDs or brokerage accounts and conservative investments that are not going to move strongly with the market. We do not want to sell stocks at low prices. So what we need to do is have some of our investments in something that's completely stable. A big part of that is determining how much you need. You don't want to invest too much money in your emergency reserve, so that because it will not get the upswings when the market is going good. Okay, so we need to determine how much you need, and defining what goes on in each household for my client is a very important part of being risk tolerant. We need to estimate your income from all sources and determine how long the monies will last. If you're getting income from something like Social Security, that will remain stable even during this market downturn. But if you are receiving income from maybe dividends off a portfolio, a lot of companies are cutting dividends and cutting their stock buybacks. That could impact the amount of money that you have to spend each month on a drastic level. So we need to make sure we know how much of the income is stable, how much of that income is not, that may be contingent on the marketplace, and set you up with the right amount of emergency reserves so you don't do without when the market goes down. One thing just incredible is do not sell your equities in a low market if at all possible. Sealing in the market downturn by selling and taking the capital loss is not a good strategy. A lot of people think that taking a stock loss is good because it offsets ordinary income. But what that does effectively is when you hand the government $3, they hand you back one. Having a loss is okay if you have gains to set it up, but taking the loss so you don't have to pay taxes is kind of a losing strategy, definitely a losing strategy. We need to look for alternative monies. And one of the things, some people have extra cash to set on hand, and they can last 6 months to a year. But if something happened drastically, where are they going to go for assets? When times are good, when you're employed, or when the markets are calm, it's a good time to set up a home equity line against your house. A home equity line gives you open reserve area. If you think having excessive months of emergency reserves set aside is costing you market opportunity, what you can do is set that up. You don't have to use your home equity line, but let's say this pandemic, God forbid, drug out more than a couple years. I don't think it will. That is not my projection. But if it did, or if you had some kind of urgency that went on, you could utilize that home equity line instead of holding excessive amounts of money in cash reserves. Let's see. Rebalancing your portfolio. If you started out with a moderate portfolio, if you have 40% in equities and 60% in bonds, when the market, if it dropped 50%, you would only have 20% in equities and 80% in bonds. What I did here on the screen was set up with domestic equities and international equities and have both of those reduced by half to give you a graphic demonstration. What we would do is we would sell 14% of the domestic bonds and purchase 14% of the domestic equities, sell 6% of your international bonds, and repurchase the international, the 6% of international equities. Doing that would replenish you to a 40-60. Rebalancing feels good, and it doesn't feel bad like I'm going in buying something that's already gone down. Buying things at low prices is very much a female sport. We call it shopping. Men would call it a sport. It's trying to find great things at low prices. And that's what you can do in the marketplace right now. When you do this, consider what kind of account you're looking at. If you're in your IRA or another qualified pre-tax account, you are not going to be cost on capital gains, and you're not going to be able to take losses either. Those are tax sheltered, they're tax deferred, so you don't have to do those calculations. If you're in a non-qualified account, like a brokerage account that is not an IRA, you will need to be accountable for your gains and your losses when you file your taxes. So that's something that you want to do at the time of rebalancing. It's always hard to go back and try to regenerate what these numbers were. So if you go ahead and make a spreadsheet now or write it down now and keep it in your tax file, it will make it a lot easier when we go to file our taxes for 2020. What if you didn't have an asset allocation? A lot of people take a look at that pie chart and they think, well, this is the first time I'm seeing that. What do I do now? Right now, what I would do is I would go back to your December 31st, 2019 statement. And in the margin of your statement, I would start breaking down what percentage of the hold did you hold in each asset category. I would then take a printout of what you hold in your account and put down what the percentages are now. I would calculate and sell the items that are still high and buy into the items that are low to restore whatever asset allocation you were holding in December. If this market downturn has affected you and you're sitting there going, wow, I should not have been in this much equities. This is way too much loss for me to bear. I'm really seriously uncomfortable and I need to get more conservative. Now is not the time to handle that. That would involve selling equities at low prices and buying into the areas, conservative areas of the market that are up. That is not a good strategy. Selling low is never good. What we need to do is after you rebalance, let's wait and let the market correct. Let's let it get back to a more normal state and then reassess your asset allocation, your risk tolerance, and rebalance to an area that works for you. Once again, always go ahead and estimate your capital losses and gains right now. Putting those numbers together today is a lot easier than looking back in spring of next year and trying to say, what did I do? What did I buy it for? What did I sell it for? I always do that immediately. The next part may be absolutely the hardest thing we have to do. It's called being patient. We honestly don't know what's going to happen with this pandemic. We don't know what's going to happen economically as the states unfold, and we don't know how the next presidential election is going to actually how it's going to happen and how this pandemic is going to be a player in it for sure. So we need to wait and wait some of these things out and wait till the market gets back up to what we feel like and the economy is up to a normal and operating level. That may be always be the hardest. Once we recover from this immediate crisis, we need to sit back and take a look at where you have your monies and go ahead and replenish your emergency reserves. If you've been living off your emergency reserves, let's pretend like that is just your savings account. That savings account is going to be down low. We need to determine where the best places are to get money and replenish that savings account and get you set back up. Let's look at your risk tolerance. And if this market downturn was a little too much for you to stomach, maybe you're invested too heavily in equities. Maybe what you need to do then is go ahead and take your investments and take a little bit more conservative approach to investing. Create a new game plan and successfully weather the next storm. Some of you may have gone through family changes. God forbid that you may have lost somebody due to COVID-19. Jobs may have changed within your family situations, but you would need to create a new game plan at that time to successfully weather the next storm. I'd like to thank everybody for coming today. If you would like, you may use the chat feature and go ahead and write out questions and put them in place. I do not have a chat visibility. Raquel does, and she will let me know about your chat. Do I have any questions?
No questions in the chat.
No questions in the chat. If you have any questions or concerns that have come up, all you have to do is email me. Here's my information, Angie@financialcareproviders.com, or you can call at 770-353-6333, and I'm happy to discuss your personal situation. Keith Knabb and his team are ready for your Medicare questions. Michelle Perlow has a lot to share on long-term care, and I can help you with your financials. What we're trying to do is pull together as experts, looking for what our clients need and looking to other experts that we can trust to help ensure your well-being. We will be sending a follow-up email with a recording of this, and we look forward to having you at our next webinar. Thank you all and have a great day.